Namaskar. We will continue from the discussions that we had the other day. Just to summarize a few issues that we discussed the other day, let us recall the discussion we had about definitions. To recapitulate, definitions are specific terms and usages found in an enactment, the law. So when you understand that law, a recourse has to be made to the definitions given in the Act. Section 2 deals with definitions. Here, an important difference has to be understood between clauses appearing in a section and subsections of a section. Section 2 has clauses. Section 6, dealing with residential status, which we will discuss later, has subsections. Now, how do you understand whether there is a clause in a section or there is a subsection to a section? Again, to understand this, we have to understand the manner in which the section has been composed. Just to give you a brief, Section 2, when I say it has clauses, see the manner in which it is worded. It reads, in this act, unless the context otherwise requires. This is what is stated as the beginning of the section. And then it gives you small Roman 1, which says advance tax means dash 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 dash. This means one small Roman letter 1 is the subclause. Sorry, that was English 1. English 1 is the subclause. Then you have English 1 capital A, agricultural income means. So this is Section 2, Clause 1A. Then you have Section 2, Clause 2, which deals with annual value, and so on. Come to Section 6. I am trying to illustrate how do you understand whether a section has clauses or subsections. The framing of the section leads you to understand. We will discuss Section 6 a little later. Let us come to Section 5, dealing with scope of total income. If you see the wordings it says 5 into bracket 1, which reads, subject to the provisions of this act, the total income. 5, 1 into bracket 1. That is the subsection. Then you have subsection 2, which says, subject to the provisions of this act. Again, it says the same thing, but that is subsection 2. Therefore, it is important to understand that the clauses and the subsections in a section have to be firstly determined, whether it is a clause or whether it is a subsection. We will today discuss a few definitions which you are required to study under your syllabus. Two important definitions we will do together. Section 2, clause 34 and section 2, clause 9, previous year and assessment year. Clause 34 deals with previous year, clause 9 deals with assessment year. Previous year. Now this is something which is not new to you. These are both English terms. You have been using it very occasionally. Previous year. To a layman, and for that matter, even to a student of accounts. Previous means the last year. But as I told you, that is not the income tax meaning of the term previous year. They have defined previous year. Section 2, clause 34 says that previous year means the previous year as defined in section 3. So we need to understand the meaning of previous year as is appearing in section 3. In simple words, previous year means an accounting year. The period for which a businessman, for the time being understand businessman, later we will use assessee. The period for which a businessman will maintain his books of accounts. The period for which he maintains his books of accounts is known as the previous year for income tax purposes. You would be aware that generally in our country we have business entities, businessmen, proprietary business, partnership businesses, companies, individuals, trusts, AOP. They all maintain their accounts for the period April to March. It begins on 1st April of a year and ends on the 31st March of the next year. For example, April 19, 1st April 19 to 31st March 20. You are aware that this period is also known as the financial year. This is the period for which the central government of our country maintains its accounts. It closes its books of accounts on 31st March. So generally you have assessees, businessmen, taxpayers in India. maintaining their accounts for this period, April to March. But that is not so in all assessees. In case of all assessees, you are aware that we have several multinational companies operating in India. They have their subsidiaries in India. They have their branches maybe in India. Those subsidiaries, those multinational companies are foreign companies. They have offices, branches, subsidiaries, associated enterprises in several other countries. So they may want the subsidiaries in other countries to maintain the accounts for the same period of 12 months for which they maintain their books of accounts. For example, US companies follow calendar year as their accounting period. US government follows calendar year, January to December, as their accounting period. So those companies also maintain their accounts for that period. Now they may have, a US company may have a subsidiary in India. Indian subsidiary of US company will also maintain its accounts for the calendar year, say calendar year 19, starting from 1st of January 19 and ending on 31st December 19. The subsidiaries of this US company in other countries will maintain their accounting period in accordance with the laws of the other countries. But it will be always ideal that all the subsidiaries, wherever located, would maintain or should maintain their accounting period for the calendar year, so that amalgamation, merging of the balance sheets, clubbing of the balance sheets and the profit and loss account, making a consolidated statement of income, profit and loss account and balance sheet is easier if accounts are maintained for the same period by the parent company and the subsidiary companies. But come to the subsidiary company in India, subsidiary of the US company in India. The law does not say in India that these subsidiaries also should maintain their accounts for the financial year, April to March. It says that you maintain your accounts for any period of 12 months, no problem. But when you are submitting your income tax return, you give us your income for the financial year, meaning from April to March. So if you have a US company in India which maintains its accounts for the calendar year, January to December, then it would be required to bodily lift its income for the period 1st April 19 to 31st December 19, 9 months of 2019, and 3 months of 2020, 1st January to 31st March 2020. The incomes of 9 months of 2019 and incomes of 3 months of 2020 would be clubbed would be consolidated and filed as the income tax return for the previous year 2019-20 previous year, financial year 2019-20. So therefore you will have assessees, businessmen, business entities maintaining their accounts for any period of 12 months but submitting their return, income tax return in India for the period April to March. I hope this is clear. Accounting period can be any, but the period for which you compile your income tax return is April to March financial year. So we have discussed the second issue. Certain companies, first issue, maintaining accounts for the financial year, they will submit their return for that period. Companies, second issue, so companies maintaining their accounts by a period other than financial year, calendar year for example, they will consolidate their incomes for 9 months of 2019 and 3 months of 2020 and file their return of income in India for financial year 1920. Third case, where an assessee or a businessman starts his business during the year, during the currency of the year. For example, if you start your business, suppose considering financial year 2019-20, April 19 to March 20, if you start your business, let us say on 1st of July 2019, please remember we are discussing previous year. Year, as we understand, is a period of 12 months. But though we are filing the compiling the accounts for the period 1st July, the previous year in respect of this business which has commenced on 1st of July will end on 31st March 2020 only. That makes it 9 months. That is not a year. But year, the previous year for this business would start on 1st of July and end on 31st of March next year. So you will have a case of a year being less than 12 months for the purposes of Income Tax Act. Business started during the year, ends on 31st March. This businessman is at liberty to maintain his accounts from July to June, no problem, he can do that. But he will have to file his income tax return in respect of this period, in respect of this business for the period 1st July 19 to 31st March 20. So he may as well close his books of accounts on 31st March 20 and not on 30th June 20 when 1 year 12 months end for this business. So previous year means this. The next definition which goes hand in hand with previous year is the assessment year. Section 2, clause 9 deals with assessment year. Assessment year and previous year are related to each other. Previous year precedes the assessment year. Assessment year follows the previous year. Meaning, first you have the previous year and then you have the assessment year. as we have discussed. Previous year 1920, April 19 to March 20. The assessment year relevant to this previous year 2019-20 would be a period of 12 months immediately following the previous year, the financial year. Meaning, for the previous year 2019-20, the assessment year would be the period of financial year immediately following the previous year. So, assessment year relevant to the previous year 2019-20 would be a period beginning on 1st April 2020 and ending on 31st March 2021. So to make things clear, previous year 2019-20, assessment year 2020-21. In income tax, you will always have a reference made only to the assessment year. Hardly do you have people discussing previous years in income tax. You always have discussions based on, with reference to assessment year. We would also seek to adopt the same practice. So for your syllabus, the assessment year which you are required to study is assessment year 2020-21 related to previous year 2019-20. April 19, March 20 previous year, April 20, March 21 assessment year. I hope that should be clear. Next you have section 2, clause 7, assessee. This is a very extensive definition. In simple words, assessee, to a layman, assessee means a taxpayer. But that's not all. For a lay person to understand assessee, it means a taxpayer. You should appreciate, as I told you earlier, if a meaning is given in the statute, meaning the act, you refer to that meaning. Don't refer to the dictionary meaning. This is one word which does not appear in any standard English dictionary. This is the word coined by the Indian government. You can look up a dictionary. You will not find the word assessee. Assess, yes. Examine. Is found. You don't have assessee in the English dictionary. This is the word coined. So you have to restrict yourself to what is given. The meaning of such a word, of such a term, when it doesn't exist in the dictionary and it is defined only in the act, the meaning has to be specific, clear. So therefore, if you would recall, I have told you, certain terms are inclusive, certain terms are exhaustive. This is one term, assessee, is one term, not defined in the English dictionary, defined only, coined only by the Indian government, is an exhaustive definition. They are giving you the meaning of assessee. Section 2, clause 7 gives you the meaning of assessee. You have to restrict yourself only to that meaning, nothing more, nothing less. To explain assessee. It means any person by whom any tax or any other sum of money is payable in accordance with the provisions of the Act. Tax or any other sum of money is payable. Now you may wonder as to what does this any other sum of money mean, into quotes, any other sum of money. Tax obviously means the income tax. Any other sum of money would mean cess, surcharge, interest, penalty, fees, compounding fees, and any other tax liability arising in accordance with the Income Tax Act 1961. So if a person has to pay income tax, he is an assessee. If a person is required to pay interest, he has paid the tax. He is required only to pay the interest or the penalty or the fees. He will still be considered to be an assessee. Second category of assessee. An assessee includes an assessee in default. This needs explanation. Let me give you a simple illustration. I am trying to explain to you the meaning of an assessee in default. Let me give my instance. I am a teacher at this college, working for the college, drawing salary from the college. Supposing my salary is rupees 1 lakh per month, and my total salary is rupees 12 lakh in the year, and the tax liability thereon comes to say rupees 2 lakhs to make things easy. I only have salary income, assuming 12 is my salary income for the year, 2 is the tax liability on that salary income. I have no other income, assuming. The college is entrusted with the task of deducting 2 lakh rupees from my salary of rupees 12 lakhs and pay me 10 lakhs only and deposit 2 lakhs on my account under my PAN, permanent account number, with the government of India. So when I file my income tax return, I would show 12 lakh salary, 2 lakh tax liability, 2 lakh paid by the college. I will have no further tax liability. We are discussing assessee in default. The college has its own incomes. Assuming the college has its tax liability also. Assuming the tax liability of the college. 2 lakh rupees was the liability of TDS, tax deduction at source, was my tax liability, which the college has deducted. Supposing the college has a tax liability on its own incomes of rupees 50 lakhs. It has deposited rightly 50 lakh rupees with the government of India as its own tax liability on its own income. But supposing the college defaults in tax deduction from my salary, Please remember, college has paid its own tax of rupees 50 lakhs on its income. In respect of rupees 2 lakhs, which is my tax liability, which the college is required to deduct, it is the liability on the college, enforced on the college by the government. 192 section. If the college commits a default, there can be 5 defaults in this respect, with which we are not concerned with now. If the college commits any of the 5 defaults in respect of my tax deduction liability from salary, the college will be considered to be an assessee in default. Mind you, it has paid its own tax liabilities, to own tax dues correctly, but has defaulted in deducting tax from my salary. Therefore, the college can be proceeded against by the government, by the department. The college will be considered to be an assessee in default. Now there may arise a question, it is my income, I am required to pay the tax. That is right. That issue we can discuss a little later, when you are fairly equipped to understand the fallouts of this, maybe later. But unfortunately your syllabus doesn't warrant that kind of a study. That's a different issue. To those interested, I will certainly want to discuss this with you, that when 2 lakh rupees is my liability, why should the college be held responsible for the payment of this, deduction of this? That will be an issue for later discussion, not forming part of your syllabus. That's a different issue, but I will certainly want to discuss. So, an assessee in default includes a case where a person is required to pay certain dues by way of taxes and interest and penalty in respect of the deeming fiction. Deemed, because an assessee includes an assessee in default. When it is in default, not for its own liability, but for liabilities incurred by way of tax deduction at source. Third category of assessee, representative assessee. That is needing a bit of explanation. You have been in India, your brother, let us say, has now settled abroad. He has Indian incomes, let us say by way of rent, getting out of property, income by way of fixed deposit from bank FDs, interest on fixed deposit from bank FDs, dividend from shares, and so on. He is not expected to come to India on a yearly basis, determine his income and pay taxes. Of course, now we have e-filing, where nobody visits income tax offices. We file it through the net. He can do it as well through the net, seated in a foreign country. But he is required to appoint a representative assessee in India. The purpose of appointing a representative assessee, I think, will be clear to you. Supposing he has incomes and he doesn't pay his taxes in India, Indian incomes only he has, and he doesn't pay taxes in India, who will the Indian government go to for recovery of taxes? The representative. So therefore, The government cannot prohibit your brother from settling abroad, but it only requires him to appoint a representative in India on his behalf who would be responsible for payment of his tax dues, timely payment of tax dues. So, elaborating on this, you may have your own incomes in India. You may be filing your own return in India. Supposing you have an income of 10 lakh rupees on which you pay tax under your pen. Your brother may have an income of 25 lakh rupees. You will not add that income to your income. It will not be 10 plus 25. No. You will file two returns. One under your pen. Two, second return under your brother's pen, which will include only your brother's income, not your income. If there is a tax liability, tax or any other sum liability in respect of your brother, you, the representative assessee, would be held responsible. So now you can relate. Assessee includes a representative assessee also. So you are an assessee even for your brother. Your brother's liability will have to be settled by you because you are a representative assessee. So to summarize, assessee means any person by whom any tax or any other sum of money is payable. Assessee includes an assessee in default, college, as I explained to you, and assessee includes a representative assessee. These are the three inclusions in assessee. Business. Section 2, Clause 13. Students of commerce, as you are, have used this term at least 100 times over the last few years. Understanding of the term business that has percolated in your senses is okay, fine. But you need to understand business as it is defined in section 2, clause 13. It is one of the simplest definitions, or rather the shortest, one of the shortest definitions. We have definitions running into pages. It's a different question. This is the shortest, 2.5, 3 lines definition, but the most litigated. In income tax, we have abundance of litigation. Nothing is free. Nothing is in a way simple in income tax. Hugely litigated legislation, very litigated as to what does business mean. We can discuss this term business for maybe hours together, but I will seek to give you a few interesting issues. Business, it is an inclusive definition. It starts with the word business includes any trade, commerce or manufacture or adventure or concern in the nature of trade, commerce or manufacture. Such a simple definition. I recall a judge, of course in a different context, he was asked to define what is culture. He very rightly said, I cannot define culture, very difficult to define culture, but I will certainly tell you where it is absent. The same may be the case with you as well when you are seeking to define business. You may find it difficult to define business But you may, when confronted with a situation, explain that there is no business in it, in a transaction. So business includes trade, commerce or manufacture. Trade, commerce or manufacture, or any adventure in the nature of trade, commerce or manufacture. Adventure or concern in the nature of trade, commerce or manufacture. These are very, very wide terms. Trade, commerce or manufacture. Now they have sought to cover everything with the instincts of a trade or commerce or manufacture in the meaning of the term business. So a person engaged in any of the activities related or in fact being trade, manufacture or commerce, it will be a business activity. This definition is important because it is only when you have a business activity of the nature referred to in this definition can you include the income from that business under the head profits and gains of business or profession. As I have told you earlier, conditions are specific to the head. To include income under the head business income, profits and gains of business or profession, there has to exist business income, and business income is understood in this fashion. Business means any activity of trade, commerce or manufacture. If you have an income generated through trade, commerce or manufacture, or any adventure or concern in the nature of trade, commerce or manufacture, it will consider to be a business activity falling under the head business income only. Try to understand. Definition that we do now, that we understand now, will have implications on the heads of income. Inclusion or exclusion. So be very specific. Any activity of the nature of trade, commerce or manufacture is sufficient. Adventure or concern in the nature of trade. That word adventure here is very important, extremely important. In a city like Mumbai, boarding a train from Goregaon at 8:30 a.m. is itself an adventure. How do you understand adventure in the meaning of business? Something may very easily come to your mind that I can be into adventurous sports activities. I can train kids or people or children for sea surfing, deep sea diving, mountaineering, rock climbing. As people have their professional activities, business activities, you can have this activity. Those activities are purely adventurous in nature. Nobody does that except you if you are in that business. On a daily basis. If I ask you, how many of you go river rafting, mountaineering, deep sea diving on a daily basis? Maybe once in a year or maybe once in a lifetime also. So what I am trying to explain to you here is that adventure refers to maybe singularity, single activity, or maybe an occasional activity, or maybe an incontinuous activity, not continuous activity. But if that activity, singular activity, occasional activity, incontinuous activity, is in the nature of trade, commerce, or manufacture, that singular activity also, if it has the characteristic of trade, commerce, or manufacture, that singular activity would also classify to be a business activity generating income under the head business. This may be surprising to you. Take our mango sellers. This is the season now. We have friends, we have people in our locality who are into mango business. That's a very seasonal business. Few months, March to July maybe, they're extremely busy selling only mangoes. Occasional, seasonal income from sale of mangoes, which is an incontinuous, repeated year after year, but not during the year, throughout. That income will qualify to be a business because that activity, that transaction has the characteristic of trade, commerce, or manufacture. Consider a case where some relative of yours in a remote area, let us say in one of the rural areas, phones you up and tells you, please send me 1000 watches of this brand. It is not readily available here. You find this an opportunity. You purchase those 1000 watches, say for rupees 10 lakhs, and you send it to them, to your relative, for charging them rupees 12 lakhs. You send it to him, he sends you 12 lakh rupees, you make the payment of 10 lakh rupees towards purchase, 2 lakh rupees remain with you, and then you don't do that activity at all. It was never your intention to do this activity, and you don't even pursue that activity later. That's all, one time. During the lifetime, you haven't done that kind of an activity. But since that activity had the characteristic of trade, commerce, that income, 2 lakh rupees which you earn, qualifies to be business income even when there was a singular transaction in the year, in the lifetime. But since it had those essential ingredients of trade, that activity qualifies to be a business activity. So in other words, continuity of an activity is not essential for an activity to qualify as a business activity. This is what I am trying to bring home. That is sufficient. Singularity is sufficient. Occasional nature of the activity is sufficient. I am reminded of a very interesting case law, Nirja Birla, where a young girl like you from the Birla family, she made a huge gain from sale of shares. And when she filed the return of income, the head under which this return of income, this income was offered, this gain on sale of shares was offered, was the head capital gains. Now try to understand. The other day I tried to discuss with you capital gains, and now we are discussing business income. Please understand, the transaction was of sale of shares, and that too, she held the shares for a very short period, less than 2 months, and made huge gain upon the sale of shares. As I told you, that income from sale of shares was offered under the head capital gains, where the rate of tax now is only 15%. Whereas if the same income, same amount, let us say 50 lakh rupees for easy understanding, if it is offered to tax under the head business income, the rate of tax will be 30%. Nirja Birla offered her gain on sale of shares under the head capital gains, where the tax rate was far lower. The department considered the same income to be business income, falling under the head profits and gains of business or profession, and brought it to tax accordingly. So now you can understand. A transaction was considered by the assessee, the taxpayer. Now I will use technical terms. The transaction was considered by the assessee as capital gains income, yielding capital gains income, whereas the department considered that transaction to be yielding business income. The rates of tax are different under these heads. Department said singularity of a transaction in the year is sufficient to bring an income under the head business. The transaction, singular transaction, was considered to be a business transaction. There is no necessity for continuity. This is what the department said. So, business does not require continuity at all. The intention behind an activity is pivotal, is very important. If the intention behind an activity is that of profit, that activity qualifies to be a business activity. You are aware, nobody undertakes an activity, more so an activity which has the characteristic of trade or commerce or manufacture. Nobody undertakes such an activity to incur a loss. The intention behind that activity is to make a profit. So, the existence of the intention is sufficient to classify the activity as a business activity. Compare this profit as an intention from a business activity as with an investment. Investment also may result into a gain upon sale. Gain results from sale of an investment. I will later explain this with the usage of capital asset. A gain results from the sale of a capital asset, an investment. The intention behind that was investment. When the intention of a transaction is investment, gain would be made upon sale does not mean that gain would be brought to tax under the head business income. It is only the sale of capital asset which will result into capital gains. So, if there is a gain on sale of capital asset, I would use two terms here: capital asset versus a business asset. Business asset is stock in trade. Capital asset is certainly not stock in trade. Capital asset is held for a different purpose. A business asset, stock in trade, is held for sale. That's important. Even if you keep on acquiring stocks, you acquire the stocks only with an intention to sell. It may happen at times. People may go on hoarding the business asset, stocks, in anticipation of the sale. So it is held for sale. But that is not the case in case of a capital asset. It may be ultimately sold, but the purpose of holding a capital asset is not sale. Sale may accrue at a later date, but a capital asset is held maybe as investment, maybe as deployment of surplus funds. You may sell it. That's a different question altogether. And upon sale, you may make a gain. But that does not mean that gain is from sale of business asset, stock. Sale of stocks gives business income. Sale of capital asset gives capital gains. At your level, this may suffice. But then, as I told you, in income tax, nothing remains easy. There have been n number of cases where the department has considered sale of shares as business income and successfully been able to argue even up till the Supreme Court that the sale of shares is a sale of capital asset, is a sale of business asset only, resulting into business income. And the Supreme Court has upheld it. All depends on the facts of the case. It is the facts of the case which determine whether an income is a business income or an income is a capital gains income. We will later discuss the provisions of capital asset. For the time being, it is sufficient to understand business is a very intricate term. Income from sale of business qualifies under the head business income. Income from sale of capital asset is chargeable under the head capital gains. So today we have discussed assessee, previous year, assessment year, and business. We will continue with the other definitions in the later class. Thank you very much for a patient hearing.